multi-best-selling author of Crash Proof and The Real Crash, Peter Schiff, is my guest today. Peter accurately predicted the economic crisis in the United States, but whenever someone credits him with calling the crash, he's quick to warn that what happened in 2008-2009 wasn't the real crash. It was only a tremor before the earthquake. Peter, in your latest book, you assert that the United States is already bankrupt and should just declare bankruptcy and reorganize. In other words, take the pain for our debt sins now in a controlled fashion rather than risk a violent crash later. Do you still feel this way?
Well, I mean, absolutely feel the same way, because the only way that we can avoid the inevitable is to keep creating more inflation and continue to blow air and asset bubbles that undermine real economic growth. So, right now the Fed is winding down QE4, and they're, pretending that they're going to start raising interest rates. But they actually can't do that, because of the enormity of the debt that we have. If interest rates actually went up, we lack the ability to pay. We can't service the debt at a normal rate of interest. The federal government can't do that. And so ultimately what's going to happen is the Fed is going to end up doing QE4. Right? Rather than raising rates, they are going to do more stimulus. Because as they stop quantitative easing, the economy is now heading back to recession. I mean, people, are looking in the rearview mirror when they look at these last couple of quarters of GDP growth. Most of the data that comes out about the U.S. economy has been negative, and it's been very negative for months. And so I think you're going to see a very rapid deceleration now that the Fed is no longer providing all the monetary support, and people are starting to brace themselves for higher interest rates. So this whole bubble economy that the Fed inflates, starts to implode without the air. And the big drag, of course, is it's all debt, right? We're all depending on American consumers to spend, but consumers are broke. They've borrowed too much money. The government's borrowed too much money. And the only way to solve these problems is to, allow the debt to, to be discharged. And people have to stop spending. They have to start saving. Government has to cut spending. The Fed has to let interest rates go up. But none of this is happening. All we're doing is trying to delay the pain by exacerbating the disease that's causing the pain.
Yeah, but do you think our policymakers in this country have the guts to make such an unprecedented decision?
Well, it's not even about guts. I mean, it's just it's where their priorities lie. They're concerned with getting reelected, and so they don't want to do something that jeopardizes their reelection. And dealing with these problems, we do that because in order to effectively deal with these problems, you have to admit that there is a problem. You have to admit what the source is. And politicians don't want to do that. I mean, because they basically have to admit they've been lying to the public for years, that all the things that the government has done to help the economy have actually made it worse. And that the tough medicine that's required now is the result of all the snake oil that the politicians have been spoon-feeding us all over the years. And which has allowed the problem to get worse. So, they just, their own self-interest is to pretend that the problems don't exist, or to try to get the Fed to, cover them up. And that's what's going to happen. You're seeing this now. The oil market is going down, and people are worrying, well, is this going to be a problem for the stock market? It's not that the oil price going down is the problem. It's just indicative of the problem. Oil prices were propped up by the Fed. So were home prices, so were stock prices. And if the Fed is not going to be there anymore, all the prices that were influenced by QE are going to come down. And since, the U.S. recovery was a function of inflated asset prices, as these asset prices inflate, then the recession is going to return. And of course, what is the government's response? It's going to be more QE. But the real issue is that the recession is part of the healing process. It's part of what is necessary. the reason we don't have real economic growth, the reason that the poor are getting poorer, the divide between the rich and the poor are growing, the middle class is disappearing, right? People are reporting great dissatisfaction with the economy. Look at the voters who voted Republican in the midterms, very upset about the direction of the economy. Real incomes are falling, household net worth is declining, home ownership has plunged, the number of people living off the government has skyrocketed. Labor force participation is only rising among older people who are coming out of retirement because they're too broke to stay retired. Meanwhile, younger people, labor force participation is plunging as young people can't find jobs when they just go to grad school, and now student debt is skyrocketing because so many people can't find jobs if they're just going to school. Although a lot of the people that are borrowing money using college loans are just going to college so they can get the loans. They don't even care about the education. They're enrolling in online courses just so they can get government loans so they can pay their electric bills. So the reason that we're having this real recession underneath this phony recovery is because the Fed won't allow the recession to run its natural course. Because the recession is kind of like detox. It's what's necessary to make the economy healthy, to allow a restructuring that would facilitate legitimate economic growth. But instead of that happening, we just inflate financial bubbles. And, superficially, it looks like things are getting better because the stock market goes up, the real estate market goes up, and there's some increased spending as a result of all the extra borrowing. But all that is actually hurting the economy. And so, but if we're going to allow the recession to run its course, then debt is going to be defaulted on because there's no way around it. I mean, if the government allowed the recession, banks would fail. People would default on their debt because they couldn't, pay the interest, let alone the principal. But that is more healthy, allowing that natural free market restructuring. That process is healthier and more conducive to a return to legitimate growth than what the Fed is doing, than trying to prevent that through inflation, through printing money and quantitative easing and 0% interest rates. But the Fed is going to continue to fight this battle until it loses the war, and that means the dollar collapses. I think that's ultimately where we're headed.
Peter, you were an original opponent of the bailout as early as a year before the Bush administration even proposed it. How would you have handled the collapse of the housing market and the ensuing credit crisis?
Yeah, well, when I wrote my first book, you've been reading The Real Crash. When I wrote Crash Proof in 2005, 2006, I wrote that book, and I wrote about the coming economic collapse. It wasn't the one that happened immediately after the book came out. It wasn't the 2008 financial crisis, even though that was a large part of my book. I wrote in detail about that coming crisis and what was going to facilitate it. I wrote a lot about the housing market and what was going to happen when that bubble burst. But the first book basically laid out the premise that after the housing bubble burst, and it brought about a financial crisis and the greatest recession since the Great Depression, right? And I wrote that we'd have trillion-dollar budget deficits and double-digit unemployment. I wrote about all the things that were going to happen. I then wrote that in response to that, the government would make the mistake, the Fed would make the mistake of trying to stimulate the economy with cheap money and reflate the busted bubbles. So I wrote about the fact that they would do all this quantitative easing. I just didn't know what they were going to call it, but I just said this is what they're going to do. They're going to slash interest rates, they're going to print a bunch of money, and they're going to start buying up debt. And what I said is that action was what was going to bring about the economic crash. That it wasn't this disease that I was diagnosing that was the real problem, but the government's cure that I anticipated would be administered. And that happened. The only thing that's happened that has surprised me from the vantage point that I was at back in 2005 when I was writing that book is the length of time that has transpired between the 2008 financial crisis and the economic collapse that I thought it would usher in. Because it hasn't happened yet. It's taken longer. The financial crisis and the next crisis, the gap between them is longer than I thought, and I think it's because I made the mistake of overestimating the intelligence and the ability of the rest of the world to recognize the problem, even after the 2008 financial crisis. It's amazing the level of financial and monetary ignorance that still permeates, the establishment. I mean, the academics and big money managers, economists still don't get it, even after having been so spectacularly wrong about the state of the U.S. economy leading up to the financial crisis. They've learned nothing. They haven't questioned any of their premises, any of the dogma that they've accepted as fact or anything. Their confidence wasn't jarred by that. In fact, if anything, they have more confidence than ever in the Federal Reserve and their ability to micromanage the economy and save us, even though the Fed was so wrong and so instrumental in causing the last crisis, so completely ignorant in understanding of things. But I think that crisis is coming, and I think what's going to start it is going to be as the U.S. economy relapses into recession officially, maybe as soon as next year, and as the Federal Reserve has to call off the rate hikes and replace it with QE4, maybe then the light bulb will start to go off, in enough people's heads to perceive the box that we are in. And the reason that people have confidence that this is going to work is because they believe that it's all temporary, that the low interest rates are temporary, that the Fed can remove the stimulus, shrink its balance sheet, and everything's going to go back to normal. When people realize that this is permanent, that to maintain this artificial economy requires a permanent 0% rate, interest rate, and permanent QE, that the Fed can never back away, that the balance sheet has to keep growing exponentially to prevent the collapse. And when people realize that, then that's what brings on the currency collapse. Because if it's true that the Fed can never raise rates, and if the Fed has to keep on printing money forever, and there's no end game, there's no exit strategy, then there's no way to stop the dollar from collapse. And that's what people haven't figured out. They think, that the dollar's already rising, and it has been rising recently based on the anticipation that the Fed is going to raise rates. But they can't raise rates without precipitating another financial crisis, which would mean that they would have to slash rates. But that also means that as the economy starts to weaken, simply on the anticipation of higher rates, that the Fed is forced to cut rates or do another round of QE before they ever get to the rate hike. That's the catch-22 that people just haven't figured out.
Peter, we'll unveil what that coming crash will look like in part 2 of our discussion. As you say in The Real Crash, even if you don't think of yourself as an investor, you need to start paying more attention to your wealth, because our economic predicament means there will be no easy way to protect your money. For Wall Street Daily, I'm Robert Williams. Hi there, Robert Williams here, the publisher of Wall Street Daily. I have best-selling author Peter Schiff with me today. Peter predicted the implosion of the housing market and stock market in his book Crash Proof, but warns in his latest book, The Real Crash, that an even bigger crisis is on our front doorstep. In part 1 of our interview, Peter described how the United States is already bankrupt, and that policymakers would be well advised to take the pain of a bankruptcy in a controlled fashion now in order to prevent a chaotic crash later. Now, knowing full well that Washington won't declare bankruptcy, today we'll delve into what the coming crash will look like. Peter, I don't want the dollar's current rally to give our readers a false sense of security, so what's really behind the rally?
Well, the dollar is only strengthening because people expect the Federal Reserve to do things that it's not going to do, and because they have confidence in the legitimacy of the U.S. recovery. But the recovery is here only as long as the Fed is supporting it, and it's not a real recovery. It's a bubble masquerading as a recovery. But if the Fed is not blowing more air into it, it's going to deflate. And people don't understand that, at least the analysts. But, again, as you look at actual Americans who are living in the supposed recovery, from their vantage point, there is no recovery, right? People are worse off. The average American is worse off today than when the recovery began 5 or 6 years ago. If it was a legitimate recovery, that would not be the case. And there's never been a recovery where people are worse off at the end of the recovery than at the beginning. I mean, what did we recover from? We got sicker. People's incomes are down, their net worths are down. People are losing good jobs, and they're having to settle for lousy, low-paying part-time jobs. This is not a recovery other than just looking at GDP. But GDP doesn't tell the whole story. And, of course, I don't even necessarily trust the GDP numbers because I don't trust the source, and I don't trust the government's inflation measure because the GDP only goes up if you believe that inflation is as low as the government claims, because they have to adjust the nominal GDP numbers for the inflation rate that they say exists. And if inflation is really 1.5% a year, then the GDP is growing by 2% a year. But if inflation is really 3.5% a year, then the economy is not growing. And most Americans, from their personal experience, would say that inflation has got to be, more closer to 3.5% than 1.5%. In fact, if anything, it's probably higher.
Peter, what do you make of the analysts who are saying that the United States is a pretty good place to invest money right now? I mean, considering that we're seeing cracks in the foundations of other world economies.
Well, I mean, it's been a good place to have your money recently because of perception and expectation. But it won't be a good place to have your money when those expectations are not met and when reality sets in and people realize that they were wrong. I mean, yes, there are other economies are having problems, but the U.S. is going to have even more problems. The reason that we've been temporarily spared the consequences is because of the confidence that people have. We're able to borrow more money, and as we spend that money, that keeps those forces at bay. But of course, spending more borrowed money just exacerbates the problem because now we have even more debt. And our capacity to repay the debt is diminished all the more. And so we become all the more vulnerable to the inevitable increase in rates. And the day of reckoning gets worse and worse. I mean, look what's happening in Russia right now. I mean, they've got a ruble currency crisis, and they've been forced to raise interest rates thus far up to 17%. I mean, the Russian economy is hurting, but, I mean, nothing like what the U.S. would be going through if we had to raise interest rates to 17%. And so we go through a currency crisis. It's going to be a much bigger disaster because we're much less prepared to withstand it. If we had to raise interest rates to 17%, the debt that crisis was more of anything that the Russians are experiencing right now.
Peter, is it likely that a credit crisis in another country is what will light the fuse on the United States' crisis?
Well, credit crisis in other countries, to the extent that the Fed uses it as an excuse to do more QE. Like, I mean, there's potential that if this was a Russian debt problem in the past when we've had problems, the Fed has always been there to backstop the market. And so that might be a catalyst or an excuse to spend more money. But, in general, the thing that would hurt the U.S. economy the most would be prosperity and confidence in the rest of the world. Because we benefit from the fact that everybody seeks out the dollar as a safe haven. Well, what if there was nothing to worry about, then nobody would seek out the dollar for anything. Because we have huge trade deficits. And so if there was economic prosperity and growth happening around the world, that would really undermine the value of the dollar. And that might precipitate our collapse on its own. But, it's not going to take that, in order to, kill the dollar. The numbers are just getting too big. And as I said, our economy is not immune to what's going on around the world either. And as the Fed removes QE, it's affecting all the markets. I mean, right now people are talking about oil prices, which have dropped, better than 40%. Well, one of the reasons oil prices went up so much was because of the Fed. Well, oil prices were not the only prices that the Fed helped to push higher. Stock prices, real estate prices, bond prices, all those prices are going to come down without the Fed's help. It's a question of time. And the Federal Reserve always has a credit for their policies, positive effect on stock prices and real estate prices, but they never accepted responsibility for the similar effects in oil prices because, nobody was happy, unless you're in the oil business, but the average American wasn't happy about oil prices going up. But there were people that were happy about stock prices going up or real estate prices going up. But the Fed's monetary policy affected all those markets, and if they're not going to be there, all those markets are going to come back down. That's what people just don't understand. The stock market is going to collapse without the Fed. And if the recovery is built on the foundation of asset bubbles, well, if they deflate, what happens to recovery? It's done, and we're back in recession, which means they have to deflate the bubbles again.
Now, Peter, in your book, The Real Crash, you say that despite all the stimulus efforts, American companies are still not making capital investments. Is that another telltale sign of a coming crisis?
Yeah, in fact, that's getting even worse. In fact, I recently read an article that almost 100% of all U.S. corporate earnings are being used to finance share buybacks and dividends. And, the average age of our plant equipment is the oldest in standing, better than 50 years. So, American companies have been sacrificing their long-term viability, based on just trying to artificially enhance returns now. And a lot of U.S. companies are just taking on enormous amounts of debt, which is going to make it that much harder to make these capital investments in the future, especially when interest rates rise. And a lot of the debt is going to have to be rolled over at much, much higher interest rates. So, that's what's going on in corporate America is really a disaster. And people are whistling by the graveyard and just focusing on share prices and not looking at what's happening to boost those prices and how what the actions that companies are taking today to boost their prices are going to come back and bite them, and they're going to be the reason that prices are going to fall so much, certainly in real terms in the future.
We're even seeing some companies slashing their dividends. Is that yet another clue of what's yet to come?
Yeah, I mean, and, that shows that they're not companies don't generally like to cut their dividends, so if they're being forced to do it. And I think also the share buybacks, those are the things, you figure the share buybacks would be cut even before the dividends. But share buybacks have provided a lot of the momentum. But again, as I said, they've really screwed up corporate balance sheets.
Okay, Peter, let's get to the big question. What's this crisis going to look like, and how will it differ from the financial crisis? Your book describes a scenario that's far, far worse.
Well, yeah. Well, I think this next crisis, will be the dollar crisis. Look like what they're experiencing in Russia right now with the ruble dropping. And the dollar crisis will be even more problematic for Americans than the ruble crisis is for Russians. But I think that the Fed is going to have to, come up with an excuse not to raise rates and to do more quantitative easing, which is the opposite of what the market expects. But I think that people will figure it out. More people will start to figure it out. And I think as the economy weakens, and the Fed is really forced to step it up when it comes to money printing. And I think things that also might turn around, I think the Japanese might have to recognize that QE has been a failure in Japan. And maybe they'll discontinue it. That's going to be very negative for the dollar. And maybe the Europeans, and I think there's a good chance that the Europeans will not even undertake QE. Right now, everybody believes that Europe is going to do it, and they're going to start earlier next year. But I think there's a good chance that the market will be disappointed and that Europe does the right thing and doesn't do QE. And that will be very beneficial for the euro, and of course it'll also be beneficial long-term for Europe, the European economies, if they did not make the mistake that we did. But that could also help exacerbate this crisis, and we get an unexpected rise in the euro, and potentially the yen as well, against the dollar.
So what's our readers to do with their money, Peter? And their 401ks, their retirement accounts, their savings accounts. I mean, the markets aren't safe. The banks aren't safe. The dollar isn't safe. How can someone possibly protect themselves?
Well, I mean, there's no way to protect yourself really from the volatility, because you got to be, there's volatility here. But long term, if you understand what's going to happen, then it's pretty easy what to do, and that's to get out of dollars, own gold and silver, and own equity stocks in countries that have much sounder economies, structurally sound economies underlying the markets. And, buy a lot of value, and buy a lot of hyped up assets that have been propped up by cheap money and the bubble. You have to be in the right asset classes, be in the right currencies, be in the right countries, and I think in the long run, you'll come out on top. But it's kind of difficult for a lot of people to do, because in the short run, it's the people that are getting it wrong that have been having their investment strategy validated by price action, because they have a lot of confidence. The crowd has got it wrong. There's not many people in the scheme of things that actually understand what's going to happen. Or if they do, they're certainly not investing for that end game. They're trying to finesse this, and they're trying to dance while the music's playing, but they're hoping that by the time it stops, they'll have a taste of it somewhere.
Thank you, Peter. In part 3 of our conversation, we'll cover some of the specific markets like oil, gold, and even Bitcoin, and discuss how Peter expects them to behave in the year ahead. For Wall Street Daily, I'm Robert Williams.